This is the number that quietly decides whether you can open your next trade, or whether your platform slams the door shut on you mid-trade. We are talking about free margin, and why most new traders never check it until it is too late. Dana is watching Eurodollar tick higher, exactly the move she planned for. She clicks to open a second position to size up, and instead of a fill, she gets a rejection. Her balance says $2,000. Her equity says $2,100. She is actually up on the trade. But one field on her screen reads 0. Free margin, $0. Not her balance, not her equity. A completely different number, and that number is the one deciding whether she trades again today. By the end of this, you will know exactly how that 0 got there, and how to see it come in 3 trades before it happens. Here is where that 0 starts. Every time a broker lets you open a position with leverage, they set aside a slice of your account as a good faith deposit. That slice is called required margin. And it is different for every open trade depending on size and leverage. Used margin is simply the total of every required margin across every position you currently have open. 1 trade, 1 required margin number. 3 trades open at once, 3 required margin numbers added together. That total is used margin, and it is the first half of the puzzle that eventually froze Dana's account. Now take your equity, that is your balance adjusted for whatever your open trades are doing right now, up or down, and subtract used margin, the total tied up in those open positions. What is left over is free margin. It is the portion of your money that is not locked into a trade, sitting there ready to be used. Equity minus used margin equals free margin. That is the entire formula, and everything else in this video is just what happens to the numbers on either side of that subtraction. Quick warning before you go hunting for this on your own platform. Free margin is not always the label you will see. Some brokers call it usable margin. Some call it usable maintenance margin. Others print it as available margin or available to trade. 4 different labels, 1 identical calculation underneath. If your platform does not literally say free margin anywhere, look for one of these instead. It is the same number wearing a different shirt. So why does this number matter enough to block a trade? Free margin does 2 jobs at once. First, it is the gatekeeper. Before your broker lets you open anything new, it checks whether you have enough free margin to cover that trade's required margin. No free margin, no new position, full stop. Second, and this is the part traders miss, it is a cushion. While a trade is open and moving against you, it is free margin that absorbs that pain first, before your broker ever considers a margin call or a stop out. Here's the key though. The exact same free margin number means something completely different depending on how volatile the pair is and how much room your stop actually needs. Context always beats the raw number. Where you stand relative to that room is what actually matters. Say Dana's Eurodollar long moves further in her favor. That unrealized gain is called floating profit, and it flows straight into equity. Equity goes up in real time as the trade prints green. Since free margin equals equity minus used margin, and used margin does not move, that entire gain shows up as extra free margin. Pause the video for a second and guess. If her floating profit grows by $300, what happens to her free margin? If you said it goes up by roughly the same $300, you have got the relationship. Winning trades quietly hand you more room to trade with. Now flip it. If price turns against the position, that is floating loss, and it drags equity down the exact same way profit pushed it up, dollar for dollar. Used margin still has not moved, so every dollar of that drawdown comes straight out of free margin. Free margin is shrinking, and it is shrinking faster than most traders are watching. This is the part that actually saves your account, and it is coming up next. Because once that cushion runs out, the story stops being about opening new trades and becomes about whether you keep the trades you already have. Before we go further, pull up your own Eurodollar chart right now, live, and pull up your account panel next to it. Find whatever field is doing this job for your broker, free margin, usable margin, available margin, whatever they call it, and just watch it for 30 seconds while price moves. You will see it tick with every candle, rising when the pair moves your way, falling when it does not. That live tick is the entire idea happening in real time in front of you, on the exact pair we have been using the whole way through. Let us build the actual math, starting simple. Say Dana's account has a $2,000 balance, and no trades open at all. With nothing open, there is no required margin anywhere, which means used margin is 0. Equity, with no floating profit or loss to adjust it, is just the balance, $2,000. Free margin is equity minus used margin, 2,000 minus 0, so free margin equals the full 2,000. With no positions open, balance equity and free margin are always the exact same number. Now Dana actually places the trade. Classify it simply. This is a bullish continuation setup, about as basic as it gets, not some complex multi-candle reversal. Her entry trigger is a clean break above the recent high on Eurodollar. Her stop goes a few pips below the last swing low, with a little wiggle room so normal noise does not tag her out, and her target sits at twice that risk, a 2-to-1 reward. Remember, a setup like this never guarantees a winner. Breakouts fail constantly. The stop is the only thing that actually saves the account. And where this breakout happens on the bigger chart matters far more than the shape of the candle itself. Context beats pattern every time. Now the margin math. Her broker's leverage on this position makes required margin $100. Since it is her only trade, used margin is also $100. Her equity balance plus the small floating profit she currently has is $2,100. Subtract the $100 of used margin, and her free margin comes out to $2,000 exactly. Flip that same formula around, and you get the relationship that ties this whole video together. Equity is not just some standalone number. Equity is always exactly equal to used margin plus free margin. Money tied up in trades plus money sitting free equals everything you have got. Every time equity moves, one of those two pieces has to move with it. That is not a coincidence. That is the whole system working exactly as designed. So back to Dana. Locked out at 0, here is exactly what that number was telling her. As her floating profit gave way to losses on other positions, free margin got eaten down to nothing. At 0, her broker will not let her open one more trade, no matter how good the setup looks. There simply is no free margin left to back it. Go negative, past 0, and it gets worse. That is the territory of a margin call. Or in the harshest case, an automatic stop out, where the broker starts closing your positions for you, without asking. This is the thing this whole video has been building to. That locked out screen was never random. It was free margin hitting the floor, in plain sight, the whole time. Quick recap. Used margin is the total required margin across every open position. Free margin is equity minus used margin, the part of your money not locked up. It does two jobs, opening new trades and cushioning losses before a margin call or stop out. Floating profit pushes it up, floating loss pulls it down, dollar for dollar. And at 0 or below, your platform simply will not let you in to another trade. Write this down as a rule of thumb. Amateurs watch their balance, professionals watch their free margin. Dana's locked out screen at the start of this? Now you know exactly why it happened, and you would have seen it coming 3 trades earlier. Tell me in the comments which pair you are practicing this on, name it below. Next time, we take this same cushion one step further. What actually happens, number by number, the moment a margin call gets triggered.